Insider buying is a very bullish signal because ultimately insiders buy because they believe the share price will rise. Today we're looking at 3 stocks near their 52-week lows with massive insider buying. Now the first one we are taking a look at is Estee Lauder, where the director has bought on 3 different occasions this month. Once on the 14th of November, once on the 18th, and once on the 19th. And we can see in totality, he's bought around $25 million worth of shares. So let's have a very quick look at this company. As we can see, they're down around 40% over the last 12 months. Right now, they are trading towards their 52-week lows. Wall Street give this company a hold. Quant, on the other hand, give this a strong sell signal, with Seeking Alpha the only ones that are bullish with a buy signal. Now we'll talk about their dividend, as they did recently cut it. The forward yield right now sits at 1.92%, and we'll cover briefly the forward P, which does at a first glance look very high at 44.4. We also notice over the last 10 years, this company is down around 2%. So if you'd invested $10,000 10 years ago, right now your total investment would be worth less. That doesn't even factor in inflation. And we can see the peak of this company. We're talking about 3 years ago at $370. That is right now trading for $300 a share less at 73. Now we'll talk about their earnings. As we can see, their projections over the next 4 quarters, they're anticipating the next 3 in fact to be double-digit decreases, with the 4th one triple-digit growth. And when we do look back, it is nice to see that their historical forecasting accuracy is very good, 100% track record, 4 out of 4 beats, with ultimately the next earnings per share for the annual report in June 2026 anticipated to increase to $274, which ultimately will lower the forward P to 26.61, making it look a lot more reasonable. Now, in terms of this company, their dividend safety score does sit at 40, unsafe. We'll talk about why that is shortly. As we mentioned, the yield is 1.91%, and that is because they had a 47% dividend cut just last month. Now, in terms of dividend safety, this was reaffirmed a few weeks ago, and for those that want to understand the meaning behind this unsafe score, it suggests a moderate to high risk of a dividend cut over a full economic cycle. Now, key metrics, that is from the last Great Recession, 07-09, they actually maintained the dividend. They didn't increase it, but they also didn't cut it. They had negative 11% recession sales. That it says around the average. The S&P at that time was negative 12, and they also had a near S&P return, negative 52, the S&P itself, negative 55. However, over the last 5 years and the last 20 years, this company did historically increase the dividend at a very strong rate, 15% in fact over the last 20, but unfortunately we did get that dividend cut, news that no dividend investor wants to hear, in October at negative 47%, bringing their consecutive years of increases back down to 0. In terms of looking at the valuation, this is based on the PE. Blue Tunnel does indicate the expected fair price. Right now it is sitting in the midpoint, which would indicate reasonable valuation, but remember, we don't look at any of these models in isolation. We will conclude when we run it through our own valuation process shortly. Dividend yield theory, well, that tells us a company is undervalued when the current yield sits above the 5-year average. So at a first glance, you would get that signal that, remember, they did just have a dividend cut. So you could argue this model right now isn't reasonable to look at. In terms of the forward P, 40.9, very high, but that is in relation to their 5-year average, marginally lower. And as we saw, if they do hit their next year earnings per share, the forward P will come down into the mid-20s. No surprises, the consumer staples sector as a whole does trade much lower at 18.6. Now, free cash flow payout, that is something we tend to look at, and free cash flow data always over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is our blanket rule. Reason for that, we want to have faith management can offer nice increase to the dividend year on year. Now, over the last 10 years, it has been below that bar 2024. Something we do want to point out, over the next 12 months, it is anticipated to come to 93%. Definitely something we would say to have on your radar. Yes, they have already cut the dividend once. That doesn't mean they wouldn't cut it again. Something that we would just say to have some consideration for. In terms of free cash flow, we want consistent growth over the longer term. Now, it has increased purely from a 2015 to a 2024 position, but very inconsistent and minimal growth. Again, we do want to highlight here, over the next 12 months, it is anticipated to come down to $1.50. Then we move on to the sales growth, where we want to see at a bare minimum 3 to 4% just to keep up in line with inflation. Not only has it had 4 of the last 10 years as negative growth, but we also see that in 2024 at negative 2%, which when we look at it from a numerical perspective, yes, 50% growth over the last 10 years, but there has also been a little bit of inconsistency. In terms of shares outstanding, our identifier here is whether or not the company has returned excess cash to shareholder pockets through those share buybacks. Again, inconsistency. They've done a little bit year on year. Some years, in fact, they've diluted your position by issuing shares. Some years, marginal share buybacks. Again, over the longer term, very minimal movement. In terms of the ROIC, 10% or more, give us faith, management are able to effectively allocate their capital, something they've done over the longer term, but do note it has been decreasing from the highs of 30% in 2015 and 2016, 10% over the last 2 years, 11% on a trailing 12 month. Looking good, it is above our minimum, but again, just be aware their metrics do seem to have declined over the last 10. We then move on to operating margin above 12%, something we saw from a historical basis. Last 2 years though, it did start to falter down to 10% in 2024, and ideally what we look for high quality companies is also operating efficiency. We want to see margins increase, something we actually saw from 2015 to 2022. Since then though, it has gone the other way, a cause for concern. We then move on to the free cash flow margin, where we want to see 5% year on year. We do see that bar 2023, so that is positive to note. And then one of the most important metrics specifically for the dividend is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Why we say important, it does correlate to dividend safety, balance sheet strength, and the numbers that you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. A little bit of a worry for us, 0.2 in 2019, all the way up to 2.08 in 2024, even higher on a trailing 12 month, even higher over the next 12 months. We definitely would say some cause for concern. Do also bear in mind, just because they've had a dividend cut this year doesn't mean it will be repeated. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are notified of more videos as they drop. Now our intrinsic value, we have gone through this model again, updated the numbers. It's come to $69. Now we won't go through every single input and output, but typically when we do our deeper dives, we do run through these models. We haven't used the dividend discount model today due to the fact they did have that large cut, so it wouldn't be reasonable. $69, now it isn't far off the current trading price, so what we would say is right now for Estee Lauder, we do believe it is trading around its fair value. Yet with some of the issues we have identified in today's episode, we would want to see a margin of safety for sure. Now 10% MOS is where we typically start on this channel. Execute if it has our 3 golden criteria: wide moat, strong financial metrics, good forward looking data, and we notice that would be around $62. Now a lot of people would say they want a lot more. At 15% around 58, at 20% around 55, and at 25 around 52. Now, I know a lot of people may be thinking it won't get that low. Just take a look at some notable stocks that have faced similar issues, that have declined significantly. Doesn't necessarily mean it isn't a good buy now. Always have your own investment thesis. Always do your own due diligence. However, our conclusion, we believe this is trading around its fair value. Wall Street forecasts $82. They do see upside of around 12%, but do give us your thoughts below on Estee Lauder. And yes, whilst insider buying is a bullish signal, like we always say, never follow insiders or even institutions blindly, and always do your own due diligence. Now, we also want to let you know we have released our latest free weekly article where we run through 2 beaten down stocks with over 30% upside. You can grab this copy completely free by clicking on the pinned comment below. We essentially deliver one to your inbox every Monday morning where we talk about severely undervalued stocks that deserve your attention and what's gone on in the market. And on top of that, you can grab a copy of 40 undervalued dividend stocks for the month of November. Lots of information for each one, the upside that Wall Street see over the next year. And on top of that, you can grab a recently released 29 dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, sign up, and you can start reading straight away. The next stock we're moving on to is LVMH, where we in fact see the CEO President Bernard Arnault buying more on a consistent basis just over the last few days. We have the 21st of November, the 20th of November, the 19th, and as we can see, he believes these shares are very, very cheap. He continues to buy a significant amount. Now, he is someone who has been buying generally this company, However, we have noticed he is doing it at a much faster rate over the last few months. And when we take a look, it is trading right there at its 52-week low. We have a buy signal from Seeking Alpha, and over the last 12 months, they are down around 19%. Now, if you want to understand why this company is down in more detail, do check out our deep dive where we did cover their earnings. But over the last 10 years, nonetheless, they still have outperformed the S&P up 250%. Their P on a trailing 12-month is around 20.3, S&P around 25, and their yield is around 1.91%. Now, in terms of their revenue, they are expecting growth of around 5% into the next year. So even with the struggles they are facing, they do believe their top line can continue to move in the right direction. And this is a company that has been increasing their dividend from a historical point at a very attractive rate. In fact, 15% on a year-on-year basis over the last 20 years. And when we get to the free cash flow payout, pretty much below 60% every single year, 61 in 2023, 54 in a trailing 12 month. So at a bare minimum, we do want to see the continuation for LVMH of those high single digit increases. Free cash flow up to a certain point has been fairly consistent in terms of its growth. Last few years though, it has been declining from the peak of 2021, although we are anticipating a massive jump on the free cash flow to $29.90 over the next 12. Similarly, sales growth has looked good, nearly double digit every single year, justifiable COVID drop in 2020, 9% looking good in 2023, 1% on a trailing 12 month does show us that they have struggled just this year, and that is also shown up in the share price, which has dropped very, very significantly. In fact, we can show you this was a company that was trading around $959 at its 52-week high. That is essentially around 50% higher than the current trading price at $622. In terms of their top line, well, nearly threefold growth from 2014 to 2023's $87 billion. And we can also see share buybacks isn't part of their capital allocation whatsoever. In fact, it's only decreased by around $4 million from 2014 to the trailing 12 month. In terms of ROIC, looking very strong, double digit every single year, 21% over the last two. And in terms of margins, we do get some signs of operating efficiency, 19% in 2014, 26% in 2023, that is great to see, as well as the free cash flow margin, which is well above 5%, 14% in fact on a trailing 12 month. Net debt to EBITDA below 3, that is the main thing, but it does sit around 1.89 expected over the next 12, which is a jump from 2023, something to keep an eye on, but still well within the maximum threshold that we do want to note for stocks. In terms of the intrinsic value, well, today at $825 is where we get. Remember though, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for LVMH or any other company you like. In terms of Wall Street, they've lowered their target price, $760. They believe there's around 13% upside over the next year. And when we look at our own margin of safety, at 10% a buy at $742, at 15% around $700, and at 20% it isn't far off at $660, but right now for LVMH we see around 15 to 20% MOS, with Wall Street 13% upside. Remember though, take their forecasts with a pinch of salt. When share prices do drop, they tend to revise them downwards. When they start to increase, things do start to turn around. They do the opposite and start to move them upwards. The next company we're looking at is Centene Corporation, where in fact we have the CFO buying on the 13th of November around $1 million worth of the stock. Now, in terms of the actual company, it is trading towards its 52-week lows. We get a double buy signal with a hold from Quant. This one doesn't pay a dividend, but has a forward P sitting around 9. And over the last 12 months, down 19%. Over the last 10 years, this one is up 140%, but we can see some way away from the all-time highs 2.5 years ago at just under $100. Now, over the next 4 quarters, they are anticipating 3 of the 4 to in fact be green positive, and 100% historical forecasting accuracy, always very good to note, with the next full year growth anticipated to the earnings per share, in turn lowering the forward P to 8.52. Now, their free cash flow has grown over the last 10 years, in fact nearly triple, but we do anticipate a massive drop over the next 12 months to $6.28. And then we get to the sales growth, actually looking very impressive, double-digit increases every single year, bar 2023. On the trailing 12 month, it looks like 2024 will also be a year where the top line increases in line with inflation. And when we do zoom out, this is a company that actually has increased their top line at a very astronomical rate, nearly tenfold in fact over the last 10. But they've also diluted your position as a shareholder from 2014. But we have noted from 2021, it looks like they are doing some share buybacks, which is good to see, especially if this does continue. ROIC, no real complaints, straddling around the 10% over the last few years, 10% on a trailing 12-month basis as well. And then on the operating side, now we want to see at least a minimum of 12%. However, for companies in this industry, this is essentially what they look like in terms of the range. But again, something we do like moving forwards to see them at least move up and have some small signs of operating efficiency. Free cash flow margin, unfortunately, a little bit too inconsistent. Around 5% is what we want. Now, we do get that in 2023, but again, you can just see it does vary quite significantly year to year. However, the one thing that we really like about this company in terms of the trailing 12 month and over the next 12 months, it looks like near enough to zero, which means for CNC, it won't even take them one day to pay off all of their debt net of cash on hand. Now, our intrinsic value is quite high in comparison to the current price, which only means one thing today, that there is a very large MOS for this company. And when we do take a look at the 40% rate, around $64, that is where we see Centene Corporation. And remember, if you do want us to do a deeper dive on any of these, let us know below. With a 40% MOS and 35% upside depicted by Wall Street with their forecast of $81 over the next year, give us your thoughts whether or not this is one that interests you. Maybe you've been picking this stock up already in your portfolio. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.